waters. It's America's money program, Money Talk. On the program over the years, we've talked about taking control of your money, taking control of your personal financial future, keeping the sharks out of your life and away from your wallet. After all, it's your money. And you know, we talk about money all the time because after all, it's money talk, but is money really the most important thing? Of course it's not. Certainly the most important things in front of money are your health, certainly your time, certainly your family. Arguably, you could list money fourth in overall importance. It would have to be behind your health, your time, and your family. You could argue that you could rank it fourth. So money is important. Money is not everything. That's a bromide that is very, very true. And we talk here on Money Talk about critical mass in financial terms. But what critical mass really means is financial freedom, personal financial freedom. Freedom of your time. When you free up your time to live your life, that's huge, right? So freedom of your time is gigantic as a part of the concept of living in the land of critical mass. Certainly security. Security for your family, security for your personal independence as you live your life. And without question, critical mass means empowerment. It empowers you to provide educational opportunities for the young sprouts, for other family members. It empowers you to have the ability, the precious ability, to be able to help others. And it's a wonderful thing in the land of critical mass. There are no alarm clocks because you're no longer working for the man. You have personal financial independence, which gives you personal freedom. It always amazes me that there are those out there that try to make money a very complex topic. They try to speak of money as though, it's way over your head. You can't deal with your money. I don't believe that and never did. I am 100% convinced that you can manage your money once you acquire the basic knowledge to do so. And I think once you acquire that basic knowledge, you can manage your money successfully for the rest of your life with those basic principles in mind. And there are some keys, obviously, in what you do. One of the most important of all is when you're trying to earn the money to save and invest during your lifetime, you always want to try to make yourself a more valuable commodity in the workplace, especially if you're working for someone other than yourself. That will enable you to earn more money. You never, ever want to depend on somebody else or something like a union to protect your income. Where is that going to take you? Where is the future in that? And obviously, it is essential to understand the difference between assets and income. Hey, you don't want to wind up like most of those NFL players who earn huge incomes and then file for bankruptcy within a couple of years after their career is over. You don't want to wind up like that. You must learn to turn your income into assets in order to be financially successful. It is that investment acumen that is the key to financial success. So that's what it's all about, taking control of your money. Taking aim on a goal. The goal is to arrive in the land of critical mass, enabling you to improve the quality of your life in the process. Because once you're at critical mass, you are then living off of your investment income. Maybe you also get some pension income to go with that, but you're living off your investment income combined with any other income that you may be entitled to. That means that you have cash flow, you have the ability to use your time as you prefer to use it. Now, I know there are people out there who, even though they have that ability many times over, they still go to work every day. Warren Buffett comes to mind. He's just one example of somebody that goes to work every day because that's what he wants to do. Hey, you know what? It's his money, it's his life, and that's his business. I'm not here to pass judgment on what anybody else does with their time. That's a personal decision. But the bottom line is, if you don't want to go to work every day, like Warren Buffett still does, once you're at critical mass, you have that freedom to do other things. And that's a really big deal. I'm Bob Brinker. This is Money Talk.
Money Talk. The national debt is now
down. This is America's money program, Money Talk. Bob Brinker along with you. We thank you for joining us. Let's get Tom on the line in Illinois. Hello, Tom.
Hello, Bob. Thanks for the call. Long-time listener and subscriber, and started working when I was 14, worked till I reached 60 when I reached critical mass, and I've been retired for 2 years. I own my home here in Illinois, free and clear, since 2012, and I want to get away from these Chicago area winters. So I'm looking to relocate to the Sun Belt and to downsize at the same time. And what I'm wondering is, why wouldn't I want to, at these historically low rates, keep the equity that I'm going to get out of my house sale and maintain a mortgage at 3.5%, instead of tying up that equity again by paying cash for the house I moved to?
What would you do with the money?
I would invest that in Portfolio 3, as I am right now with my other investments, and hopefully make more than the 3.5% that the mortgage is costing me.
What is your net worth?
Including my pension that I've annuitized to get a value on that, about $1.2 million.
How much would you borrow on the property in Nevada?
Well, we're downsizing, so I'm looking at places, seeing lots of places for 2 bedrooms for $125,000 range. So
you're talking about $100,000. You're talking about $100,000 mortgage or less.
Right.
Based on what you said in that scenario, it's only a very small portion of your net worth. You are going to, if you itemize, you get deductibility of your mortgage interest at a low rate. You also get the benefit of any inflation that occurs by paying back cheaper dollars. And given the size of what you talked about, I don't have a problem with it.
All right, very good. One other just comment or question is, I know we talked a lot over the last few weeks about holding on and waiting to get Social Security until age 70. My plan is this. I'm going to be starting collecting Social Security as soon as I can, and I'm going to invest that money. If I don't need the money, then why not invest it? They say, well, if you don't need the money, then don't collect it until you're 70. But as you know, there's a long time to get a payback, probably into my 80s if I wait until 70. And then what's that incremental payback going to be over and above, what I can invest over the next 8 years, what I can collect? And that way I'll have it in my hands as well, instead of possibly getting nothing. Does that make reasonable sense?
Well, here's my answer to you on that, Tom. Given your net worth and your financial strength, it really doesn't matter. So you should do whatever you think is best for you. It really doesn't matter because you've done such a good job of building your money up and managing your money that you're in the land of critical mass. You're in the catbird seat, which means you can do whatever you like.
Well, much of that is to your advice, Bob. We appreciate it.
All right, let's get out to Baton Rouge. Clark, welcome to Money Talk.
Hello, Bob. Thank you for taking my call.
Thanks for joining us. What's on your mind?
I've talked to you in the past. I'm a long-time listener. I'm doing what you said. Instead of taking the money to the grave, I'm kind of donating it to my kids before I die. And one of the things that I'm doing now that I'm actually getting ready to do it is trying to figure out whether I should gift them to a Roth IRA or a regular traditional IRA. And I was wondering if you could help me or guide me on that. I'm trying to figure out what's the best benefit that I can give them.
How old are they?
They're in their early 20s.
Okay, good. And are they working?
Yes, they're both making about $20,000 a year.
I'll tell you what. Basically, in a case like this, I just wanted to make sure that if you were making a gift to them, and if they were going to put this in a tax-privileged account, I wanted to make sure they had the earnings to cover it. But obviously, they do have the earnings to cover it.
Mm-hmm.
Now, I think that this boils down really to a simple question, and we can talk about it and decide on it. Here's really what it comes down to. If they choose to open a traditional IRA account, then they have the ability to deduct the amount of money they put into the account, the traditional IRA account, from their earnings, and thereby lower their current tax bill. However, it sounds like they're in a low tax bracket, so that might not be the thing to do, because if they open a Roth IRA, they're going to be able to allow that money to accumulate and grow all the way out to retirement with no taxes. And so, given the fact that you've outlined what they're making now, and they're very young, I would lean strongly for them to a Roth IRA.
Yeah, that's kind of the conclusion I came to. But then, as I was estimating their taxes, I came across they've got because they don't make very much. There's actually a tax credit that they can get, a retirement savings credit in addition to the tax savings.
Right.
And I was kind of looking at that. But if you get over 18,000, if you're under 18,000, you get like a 50% credit for the amount that you put into your retirement savings. So that kind of muddied up the water a little bit.
Well, it does muddy the water, and you might want to pay for an hour of time from a CPA or an enrolled agent to go through that kind of a calculation. We're certainly not going to be able to do that on our radio cast, but you might want to sit down and go over that for an hour's worth of CPA time. I would say that that does muddy the water, because I'll tell you why. If that deduction, how much are you planning on giving them?
Oh, I'm anywhere between $3,000 and $5,000 a year.
Well, if they take $3,000 or $5,000 off of their taxable income in a traditional, and then they're going to get some gigantic rebate,
yeah,
that certainly muddies the water. So I would strongly recommend, under those conditions, that you run it by a CPA or enrolled agent in order to see how those numbers play out. In the absence of that, I would definitely be leaning to the Roth IRA. Clark, I appreciate the call. Always great to hear from Baton Rouge. Dave, it is your turn.
Yeah, Bob, can you hear me?
Yeah, I hear you, Dave. Welcome.
Okay, thanks for taking my call.
What's up?
I have what I hope is a simple question. You know, I'll refer to your newsletter and one of the funds that are listed there, the Osterweiss Fund.
Mm-hmm.
And there's a number, the estimated yield, but then there's also total return. And I'm confused as to why those numbers are different. I was wondering if you could help me understand that.
Oh, yeah, that's a great question, Dave. Yield is the interest income that is generated by the fund. Now, in the case of that fund, on a quarterly basis, the fund pays out a distribution, and that distribution, by the way, does come off the share price on the distribution date near the end of each quarter. On the third month of each quarter. It's distributed on the third month of each quarter. And so on calendar basis. So on the date of the distribution, that distribution does come off the share price. Now, that distribution represents the interest income to shareholders. You could annualize that. It will vary from quarter to quarter, but you could annualize that. And that annualized amount divided by the share price would give you a very, very good picture of the current yield of the fund. Now, when you talk about total return, you're talking about something additional, which is price change. So total return factors in the price change of the fund. Now, I'm going to give you a specific example. Let's say you have a fund that trades at $10 a share, and that fund pays a quarterly dividend, interest dividend. This is an income fund, a quarterly interest dividend of, let's say, 10 cents a share. So at the end of 4 dividends, 4 quarters, you'd have 40 cents in dividend interest. And if the fund still was $10 a share, no change in the fund share price, your total return would be 4%. That would represent the sum of the interest, which in that case was 40 cents, the price change, which in that case was 0, divided by the price of the fund, which in that case was $10, this hypothetical. So 40 cents divided by $10 is 4%. That's how you would compute that.
Okay, so if the price of the fund actually goes up, your total return will actually go down.
If the price of the fund goes up, your total return will definitely go up.
Okay.
I'll show you what I mean. Let's take that fund we just talked about, that hypothetical $10 fund at the beginning of the year, and it paid 4 quarterly dividends of 10 cents a share. So you had total dividend interest at the end of the year of 40 cents. Now let's also say that the fund share price went from $10 to $10.20. Well, you would add that 20 cents into your total return calculation. So you'd have the 40 cents, the 20 cents, you'd have a total of 60 cents divided by the $10.20 share price at the end of the year. So you'd have a yield of 5.fraction%. Your current yield would be 5.fraction%, but your total return, which would be the 60 cents you received, the interest plus the capital appreciation divided by the starting share price, that'd be 60 cents divided by 10. That'd be 6% total return.
Okay. I got it then. So the total return is really varying based on the price of a share of the fund.
Exactly.
Okay. Thank you very much, Bob.
Thank you, Dave. This is Money Talk. Uptown, downtown, crosstown, on your radio across America and worldwide on the web. It's America's money program, Money Talk. You can stream Money Talk on your computer. Download Money Talk to your smartphone. That's Money Talk on demand. Of course, the investment talk is year-round. You listen to Money Talk wherever you go, whenever you like. With Money Talk on demand, sign up at bobbrinker.com right there at the Money Talk on demand logo. For information on my investment letter, that's Bob Brinker's Market Timer investment letter, go to bobbrinker.com, request a complimentary back issue. Easily done right there at the website homepage at bobbrinker.com. Just click on the request a complimentary back issue feature. That's all there is to it. Bob is on the line. Bob is checking in from North Hollywood, California. Hello, Bob.
Hi, Bob. How are you doing today?
Doing well. What's up?
Well, I so much appreciate the Market Timer letter and your radio program. You keep us out of the dark, and we really appreciate that.
Thank you, Bob.
And so my question is, or first a quick statement and a question. Many years ago, I read a book called The Wall Street Jungle by Richard Ney, and he was assured everyone that the specialists were rigging the New York Stock Exchange. Do you feel that the stock market is in any way rigged with price fixing, or some cabal is doing anything to do that?
Yeah, I never really subscribed to the Richard Ney theory of stock market rigging. And frankly, as someone that has participated in the stock market for a long time, my personal opinion is that the stock market is not rigged. Now, you can start to parse definitions of rigged. Now, if you're talking about dark pools, if you're talking about high-speed trading, that sort of thing, there certainly is a case to be made. I think Michael Lewis made it in his book, one of his recent books. I think that there is a case to be made that there is front running. Front running would be the word that I would use, not rigged. And you could parse words as to whether that's a rigged system. But in terms of front running, yes, I think that there has been front running with the high-speed trading, and I think they've had a really hard time dealing with that. But if you talk about the stock market in general, is the stock market rigged? I think really it comes down to basics. Stock prices represent the present value of all future earnings and or dividends. That's the academic definition of the price of a stock. And I would say that in terms of the current activity, it's the supply and demand coming in, the supply of shares versus the demand for the shares coming in for the stocks each day that determine what they're going to be trading at in the marketplace. So in the pure sense that stocks represent the present value of future earnings or dividends, depending on which model you use, and in the pure sense that supply-demand dictates the price level of stocks, that's the pure sense for the stock market, and in that sense, it is not rigged.
Well, can I ask you one more question, please?
Sure.
So the fundamental value, which is the present value of the future stream, it seems that sometimes the market gets unhinged from that, and like even Alan Greenspan, when he was chair of the Fed, he talked about irrational exuberance. So, and I guess that doesn't mean it's rigged if it gets irrationally exuberant, but it doesn't always stick to the sanity of the fundamental present value.
Well, I think that's a fair comment, and I think we saw that. You'll recall the sell signal we issued in the Market Timer Investment Letter in January 2000. The market at that time was at all-time highs, and frankly, it was a bit of temporary insanity on Wall Street. I use the term advisedly because the price-earnings ratio, which historically averages a little bit better than half of 30, was up near 30, and that's just absurd. And what happened was there was just a euphoria in Wall Street, and it infected the markets. It took the price-earnings ratio up near 30, and the market collapsed. Aaron is on the line in Marin County. Hello, Aaron. Aaron, you're on Money Talk.
Hello?
Hello, Aaron. You're on Money Talk.
Hi. My situation's a little complicated. My mother passed away in 2013. She was a long-time listener, thoroughly enjoyed your program, and the newsletter subscriber for almost 20 years. Let's see. So there's about, to get right into it, maybe $500,000 in two banks, $10,000 in a CD that's matured. $230 was invested in PenFed. That was one of your advice on that. That matured this year. I-bonds, which I'll leave alone, 110. So it's roughly around 850, and then 740 invested. Oh, I'm so nervous. The portfolio.
Now, let me ask you a question, Aaron, so we can format this call to the radio. What is your question?
The question is, if I get into changing the portfolio, for all of your advice, and it's all off balance. It's all of our eggs are in one basket. If I can just read from Charles Schwab's statement, like the equities, the bond funds, and all of that.
Well, why don't we try to do it
It's off balance.
Why don't we do it a simple way?
Okay.
Well, first of all, we can't say it's off balance because now that she has passed on, it's irrelevant. So this money now will be owned by someone else. Who will own this money?
Me.
Okay, so you will own this money. So your investment objectives are what become relevant here. Your investment objectives, not hers, but yours. And so what you want to do is you want to tailor these monies to your personal investment objectives. That's what this whole exercise would be about.
I don't want to make any mistakes. It's a lifetime of saving.
No, I understand that, but I want to draw the line here that you're talking about you now. This is your personal investment objectives that are being addressed, no one else's.
Yes.
So the first thing you want to do is ask yourself, are you in or near retirement?
Yes.
Okay, well then in that case, my recommendation would be to adopt some form, and there are various formats here, but some form of a balanced investment portfolio. Now, a balanced investment portfolio for someone nearing or in retirement could vary from a basic balance of 50% equities, 50% fixed income, or you could have someone that would be nearing or in retirement that would have a low tolerance for risk and would have a very, very conservative approach. And that sort of a person could conceivably have maybe as little as 30% in the stock market and 70% in income-producing assets. So you see, it's not one size fits all. So the next question that you would be asking here would be, what about yourself? Not counting this money, leaving it out for the moment. What about yourself? How is your investment portfolio situated?
This is it. What I have is from her.
So you had nothing else?
Right.
All right, well then the approach I would take then would be to ask yourself, how much of a tolerance for risk and volatility in the portfolio do you have? It can range from zero to something else. What would your tolerance for risk and volatility be? Now, this is your money.
Oh, it's hard to look at it that way.
Well, no, you have to look at it that way.
Okay, I don't want to be too risky. I want to be conservative. And
if you want to be
long-term growth.
Long-term growth. So at the same time, you don't want a lot of volatility.
Right.
So I would say that someone like yourself could consider the possibility of adopting a very conservative balance, which would be 30% equity, 70% income producing.
What do you think about your portfolio, the three, for
me?
I think
portfolio,
and then I'm concerned about the taxes if I start selling things. I talked to someone already, and he said it's going to be almost over $70,000 in taxes. There isn't enough of what's not doing well to offset.
Well, then you have to decide. What percentage of the portfolio right now is in the stock market?
Is that equities?
Yes, equities.
75.
It's 75%.
I would love to tell you what it's in.
No, I don't want to do that.
You should know.
It's 75% in the stock market?
75 equities, 5 bonds, 8
all right, it's 75% equities and it's 25% income producing.
Yeah, 4 fixed and 7 others.
All right, so
way off, and in 3 stocks. I just like to see them quickly. You wouldn't believe it.
Well,
Apple, Chevron, AT&T.
You're saying 75% of the portfolio is in 3 stocks?
Yes, those 3, and the rest are stinkers that are losing.
Mm-hmm.
Franklin.
Well, here's what you have to do. What you have to do is you have to make a decision on whether you're going to situate this portfolio in a way that meets your objectives, which would make sense to me, or whether you're going to simply adopt the prior owner's investment approach, which sounds quite risky to me if you have concentrated positions in individual companies, and just go with that. You have to make that decision, because if you don't make that decision, nothing's going to happen.
Mm-hmm.
And if you do make that decision, nothing might happen. If you simply say, well, you know what, I don't want to pay any taxes, I'm just going to let it alone. This is the decision you're wrestling. Pardon me?
That's risky to leave it alone as well.
Well, my recommendation is to not have more than 4% in one company's stock. So if you have 3 stocks at 25% each, that certainly is taking a high level of specific company risk.
Okay. And some of her last words were, it's fun, it's easy, and you can do it. And so I'm just wondering if I can do it on my own, maybe following, subscribing to your newsletter and
well, you certainly, look.
Or do I need somebody? I'm afraid of sharks.
You should be.
I know.
What I would say is, if you want to look at a back issue of the newsletter, that's available on a complimentary basis at the website. You can get a back issue of the website to see at the website to see what's in it. But more importantly, if you want to take a look at a situation like this and make a decision on whether you're going to need outside help, yeah, I think you should be worried about sharks, because I think that the shark-infested waters right now are teeming with sharks from what I'm seeing out there. So I think that's a legitimate concern on your part. But I think that, first of all, you do need to decide how much risk you're willing to take, how much volatility you're willing to take in the portfolio, and whether you really want to take concentrated position in individual companies like that. I'm not comfortable with that. But obviously, people have different feelings about it. But I certainly would not want to have 75% in 3 stocks. I can be sure of that. Aaron, I appreciate the call. This is Money Talk.
Thank you, Bob, so much for taking my call.
What's up?
I am changing jobs right now. I'm 55, and I have about $75,000 in 401k I can roll over. I was looking for your advice on if I can pay taxes on that now and put them into a tax-free vehicle. So going forward, no tax consequences on this whatsoever. Any thoughts on that?
Well, how old are you?
55, 55.
Yeah, well, so right now it's in a 401k.
Yes, sir. I
And
changed jobs. I'm now going from company A to company B,
Yeah.
and I can roll over.
So you're thinking about taking you're thinking about taking the money into a self-directed IRA.
Not even an IRA anymore. I don't want it to be tax deferred anymore.
So you're thinking about cashing out, paying the
Yes.
taxes, and investing in a tax-free bond.
Yes. May not be bonds, maybe like life insurance products which have
No way.
some other benefits.
No way. No way. In my opinion, life insurance is not an investment.
Okay.
So that's for me, that's off the table.
That's it.
I would say, I mean, if you want life insurance coverage for the death benefit, then you simply buy term life insurance, and that's what you get. You get life insurance coverage for the death benefit. I don't use life insurance as an investment vehicle. So if you were to, is somebody recommending this to you?
Yes, I've been actually talking with a few advisors without making any.
I knew this was coming.
decision.
I knew this was coming. Somebody, let me get this straight. How much money is in this account?
Right now, it's about $75,000.
All right, so somebody is suggesting to you, you know, when I hear this stuff, it still shocks me. Somebody is suggesting to you that you take $75,000 out of a tax-privileged account, in this case a 401k, right?
Yes, sir.
And that you add that amount to your ordinary income, which is what you would have to do,
Correct.
and that you pay the federal and the state taxes on that amount
Correct.
at the marginal rate, and then you take that money and invest in so-called, I don't want to use that word, you take that money and buy life insurance products?
Yeah, the products are offered by life insurance companies.
All right, my recommendation, and somebody's recommending this to you.
Yes.
My recommendation is that you give very, very strong consideration to not taking this advice.
Okay.
This is going to make the bar for one of the worst recommendations I've ever heard.
Oh, wow. Okay.
Because, number one, you're going to have to pay a slug of your $75,000, which you could otherwise continue to invest all the way out to retirement in its entirety. You're going to have to pay a slug of that to the federal tax, another slug to the state tax, and whatever's left over,
Right.
you are going to pay a handsome, I can assure you, a handsome commission to whoever is trying to sell you on this scheme. So at the end of the day, you're going to be roadkill, Chris. You're going to be roadkill. This is my opinion.
Okay.
And if I were you, what I would do is I would continue investing your tax privileged account and forget this awful advice. That's my opinion. And by the way, I hear people, I even hear them on the radio, sadly.
Right.
I even hear people on the radio tell people that 401k accounts are terrible investments. I hear this myself. It is complete, in my opinion, it is complete nonsense.
Okay.
Complete and total nonsense. 401k programs and IRA programs are two of the very finest investment programs that have ever been provided to Americans. 401ks and IRAs, two of the very, very finest, two of the very outstanding programs that have ever been available to Americans. And in my opinion, if you're getting advice to the contrary, I'd run away from that advice as fast as I can. I appreciate the call, Chris. Thank you very much. Wow. You know, I hear these things and I just shake my head in disbelief. But unfortunately, I've heard them myself. And every time I hear them, I can't believe anybody would say that. That's my opinion. 401k programs are wonderful and they have helped a lot of people build wealth. Same for IRAs over a working lifetime. And to say anything to the contrary is, I'll be very kind here, to say anything to the contrary is most unfortunate. This is Money Talk. America's Money Program, Money Talk, coast to coast, border to border, in the islands of Hawaii and north to Alaska. Money Talk is the broadcast that helps you to learn how to become your own personal financial manager. That makes us unique. That way you can take charge of your financial future and let those sharks swim on by. Take a bite out of somebody else's wallet and leave your money alone. We talk about everything from investing for your 401k, 403b, your tax-privileged accounts, to saving for all of those important future goals, including the education of the young sprouts. The way to get that job done? Acquire the knowledge, because it is that knowledge that empowers you to manage your financial future. That's what it's all about here on Money Talk. The strategies and the tools to achieve personal financial freedom for yourself and your family, so that if you're not already there, hopefully someday you can reside in that land of critical mass, taking control of your money, keeping the sharks out of your life. I mean, after all, it's your money. Let's get John on the line. John checking in from Santa Cruz. Hello, John.
Hey, Bob. Thanks for taking fielding my question here. Can you hear me?
Yes, I'm listening to you, John.
There you go. Let me set up a simple scenario. We're going towards amortization tables on mortgages. I need to understand something. You'll know immediately. I want to set up a real simple hypothetical. I take out a $100,000 30-year fixed, and the mortgage payments are $1,000 a month. My first payment on the amortization table tells me the split is 900 interest, 100 principal. The second payment on the table tells me the split is 895 and 105. Now, I make the first payment. Before I make the second payment, $50,000 falls out of the sky, and I make a principal payment on the loan. Is the next payment still split 895, 105?
Well, I would think that if you immediately paid half of the principal off right away, that your payment schedule could be changed to reflect that payment. I would contact the bank or the lender, inform them of the payment, make sure you don't have a prepayment penalty that's going to knock you over the head.
Right.
And then they should be able to provide you with a new amortization schedule because you no longer owed them $100,000 for 30 years. Now you basically, if you do it right away, you owe them $50,000 for 30 years.
Right. Oh, I see what you're answering a slightly different question than I was asking.
No, I'm answering your question. Your question is, if you make the first payment, and then in other words, right away, you pay off half the loan.
Right.
What happens? I'm saying to you, if you contact the lender, you should be able to get a new amortization schedule reflecting the fact that you paid off half the loan.
Okay, then
because you don't owe them $100,000 anymore.
Right.
Now
right.
you only owe them $50,000, so it's not appropriate for them to charge you interest on. Look, if nothing changed, right? If it stayed the same, you'd be paying interest on $100,000 when you only had an outstanding loan of $50,000. So I think that it would make sense to have that resolved. Peter's on the line in Connecticut. Peter, it's your turn.
Hi, Bob. Thanks for taking my call. Bob, I'm a Market Timer subscriber, and a lot of times in your Market Timer you'll recommend dollar cost averaging on any weakness in the market. A dollar cost averaging, especially on any weakness in the market. Could you define for me a weakness on the market? Would it be a 3% drop, a 4% drop, a 1% drop? When would you recommend putting more money in the market on market weakness?
Well, of course, the objective of talking about buying on market weakness is very, very clear. There is a tendency on the part of investors to chase the market. You're aware of this.
Right.
Unlike any other product they buy, they seem to like buying into the stock market when it rallies, and they seem to be concerned about buying into the stock market on any kind of weakness that you see. So the whole point of encouraging people to dollar cost average on weakness is to strongly suggest to them that they stay away from that very common tendency to chase rallies, chase the market, and instead look for weakness in the market in order to dollar cost average. Now, since you're only dollar cost averaging on weakness, you're in a position where you can spread that out over time so that you get a little additional short-term weakness. That gives you even more opportunity, and many people do this. However, when we see an outright buying opportunity that we identify through our stock market timing efforts, then we make that clear to our subscribers. We did this in the July 2010 investment letter, where we recommended upgrading the market to attractive for purchase, which is a buy signal. In July of 2010, when the S&P took a dip down into the area of 1,000 in the S&P 500. We did it again in September of 2011, when a correction brought the market down into the low 1100s of the S&P 500. And most recently, we did it when the market dipped down into the low to mid 1800s of the S&P 500. In all cases that I cite, we upgraded the market to attractive for purchase, and that was a buy signal on the market. In the absence of such a moment or an opportunity, I think it makes good sense to avoid chasing rallies, waiting for rallies to average into the market, and to take advantage of weakness in the market in order to do that. Let's get Lynn on the line in California. Hello, Lynn.
Take my call. See, I got a question about the Vanguard Ginnie Mae fund. I know that you haven't recommended that fund for quite some time, but I was in that fund like in 06, 7, and 8, and 9, and I did very well on that. But is there anything that you would look for to see whether that fund could rebound or recommend again?
Well, I think that you would want to have clarification about the outlook for interest rates, and you'd also want to have a better yield than you have in that fund right now. That fund has a low yield right now, and I think that the combination of the duration of the fund and the low yield of the fund makes it possible to do better if you put together a portfolio, as we have in the investment letter, which provides you a higher yield with a short duration on an average basis. And I think those are the key variables that I use, which is really the whole point. We really don't want to take much interest rate risk when rates are at this very, very historic low level. I'm Bob Brinker. This is Money Talk.
Money Talk.
Well, whether you're just a bank account away from America or you're the president of the Bank of Mom and Dad, you're always welcome right here on America's Money Program, Money Talk. Nice to be the president of something, right? Even if it has to be the Bank of Mom and Dad. We're in Palmyra, Pennsylvania. Greg, it's your turn. Welcome.
Hello, Bob.
Welcome.
I have a required minimum distribution coming up next year, and this created some research on my part, and I'm considering a possible direct rollover to what I perceive to be a lower expense ratio fund. And I'm trying to be data dependent. So I'm currently, and I've been all my life, as a college counselor with TIAA CREF. And I have never done anything in terms of a possible direct rollover before, but I noticed that my CREF stock equities, of which they make up 40% of my portfolio, and I've been blessed. I have a $2,600,000 portfolio. So the other is in guaranteed 60%. I'm considering moving direct rollover the CREF stock, which has an expense ratio of 0.49%, to Vanguard, which I have a traditional IRA in, which is modest. It's a index 500. I have the Admiral shares, and I'm thinking of rolling it over to a 0.05 expense ratio, and then once I'm there, I would have it in the total stock market index. I'd change it from 500 to total stock market, and put 80% in that and 20% in FTSE All World, because this CREF stock that I'm in has 68% in U.S. equity and 30% in international. So I think like I would be replicating the CREF stock, but in this rollover, I'd be saving, I think, a lot in the expenses for $1 million. And I'm just wondering if you could comment as to whether you think I'm thinking clearly, because I'm nervous because I've never done anything this drastic before. I've been keeping things steady. I've been in a relatively low load fund with CREF stock, but I noticed it even 0.49% compared to Vanguard. 0.05% is, it seems to me that is a significant difference. And I'm wondering if you could give me your comments.
So your asset allocation would remain the same. There would be no change in your percentage asset allocation. What you're talking about is removing the money from what you consider to be a high cost index fund over to a minimal cost index fund in the form of the total stock market index Admiral shares at Vanguard. Is that accurate?
My perception is 0.49% is compared to the industry, low. But if I can go from 0.49% to 0.05%, I'm wondering if that's significant enough to make the rollover change.
Yeah, I would definitely do that. And for me, that would be a no-brainer. Appreciate the call. Thank you. For information on my investment letter, that's Bob Brinker's Market Timer investment letter, go to bobbrinker.com and request a complimentary back issue. Very easily done. Visit bobbrinker.com, the website homepage, click on the Request a Complimentary Back Issue feature, And that's all there is to it. Ashley joins us in Grand Rapids. Hello, Ashley.
Hi, how are you doing?
Well.
Good. I have, in the last year and a half, just started contributing to a Roth 401 or IRA, and I am wondering if it's better to pick the mutual funds myself or pay the fee to have the people at the company pick them.
Well, if you have the option of taking a total stock market index or an SP 500 index fund, I would rather do that than hand over discretion to someone at the company. Do you have that ability to pick a total stock market index or an S&P 500 index fund?
I don't know.
Well, that's what I would check. I would go to the list of funds that the company provides for you to invest in, and I would the first thing I'd look for would be a total stock market index fund, and see if they have that. If they have that, I would choose that. If they don't have that, then I would look for an S&P 500 index fund and see if they have that. That's what I would do. I would rather be there than, especially the total stock market index, by the way, because that's more inclusive of the mid caps and small caps, thereby more diversified. That would be my first choice, and I would rather do that than have somebody at the company picking funds.
Okay.
All right.
Great. Thank you.
Thank you, Ashley. Let's get Chris on the line in Milwaukee, home of the Brew Crew. Hello, Chris.
Oh, hi, Bob. I just can't believe I'm on this phone call with you. I want to thank you for all the knowledge you've given us over the years to help me manage my money myself. My question today is about going forward with either Roth money or traditional IRA money. My husband and I are in our mid-50s and probably will retire 10 years from now. And I find that I have about 90% of our portfolio in IRA accounts and 10% in Roth. So going forward, would you recommend keeping the new money in IRA pre-tax accounts, or start balancing out our portfolio and putting money in Roth accounts?
I think the most important thing is you take full advantage of any matching program that you have in your. Are you doing that?
Yeah, we are doing that. My husband has a partial match.
All right, you have to.
I have no match.
We have to do it. Your husband has, in my opinion, your husband has to take full advantage of the matching program. You don't have one, doesn't apply to you. It does apply to your spouse. As long as he's doing that, beyond that, I don't have any problem with you adding to some money to your Roth account. You can stream Money Talk on your computer. You can download Money Talk to your iPhone. It's called, and your smartphone. It's called Money Talk on Demand. With it, you can listen to Money Talk wherever you go, whenever you like. And the investment talk is year-round. Sign up at bobbrinker.com at the Money Talk on Demand logo right there on the website at bobbrinker.com. While you're there checking out our recommended reading list in the book section, scroll down on the left side. You'll see the word books. Click there. You'll see our amazing recommended reading list that I've compiled over decades, my favorite books, almost all of them in the financial realm, and lots to learn there. If you're a new listener, a new beginning investor, check out Common Sense on Mutual Funds by John Bogle, who has guested on our broadcast. John Bogle, B-O-G-L-E. Common Sense on Mutual Funds, one of many outstanding tomes on the bobbrinker.com recommended reading list in the books section. Money Talk is the program that helps you to learn how to become your own personal financial manager. That way you take charge of your personal financial future. Everything from investing in your tax-privileged accounts to saving for all of the future goals, including the education of the young sprouts. That's what Money Talk is all about, acquiring the knowledge that empowers you to to manage your financial future and let those sharks swim on by. This is Money Talk. Money Talk is about taking control of your money and keeping the sharks out of your life and especially out of your wallet, because after all, it's your money. This is a time of year when there are so many things that you can do to make sure that you have your investments lined up the way you want them lined up on New Year's Eve. The last transaction day for the stock and bond market will be Friday, and that will be a full day as always. Stock market stays open all day to the close, to the regular closing hour on the last business day of the year in order to give you the opportunity to do whatever transactions are on your list. And of course, this is the time of year to look over your portfolio and make sure you are where you want to be. One good example, checking your asset allocation. Because, asset allocation can change over time, especially when you're in the type of a bull market that we have seen since 2009. Now, that could change your asset allocation, especially by increasing your stock market allocation beyond where maybe you want it to be. So check it out. And if you want to be a balanced investor, you can check out your allocations and see whether you are as balanced as you want to be. Especially over this kind of a market, those allocations can change because stocks have gone up so very, very much. In fact, the S&P 500 now has more than tripled since March of 2009. Another thing you want to do is make sure that your liquidity needs are set. Liquidity needs can mean, I have to take a required minimum distribution. I need liquidity needs in my tax privileged account in order to do that. Certainly it makes sense to have 3 to 6 months in liquidity available for the unexpected, for emergencies. And without any question, there are so many opportunities now to take advantage of tax-sheltered savings vehicles, more than ever before. And the amounts are higher than ever before. $5,500 for those of you under 50, those of you 50 or more. You can put up to $6,500 in your IRA account. Now, in addition to that, there are very, very generous limits on tax-privileged accounts such as the 401ks, the 403bs, and the 457s. To give you an example, many people who work for a corporation have a 401k available to them. Many teachers and other such employees have 403bs. Many firefighters and police officers have 457 plans. So check with your human resources department to see what is available to you, because you will find in a lot of cases on the 401k, sometimes on the 403b, you will find a matching offer. And the matching offer that is given to you is free money if you'll take it. If you'll take it. Not everybody does, and that's a shame. I hope everybody listens to Money Talk that listens to Money Talk takes it, because it's money on the table. You just have to scoop it up. How do you scoop it up? You abide by the provisions of the program. Let me give you an example. You have a 401k, and your employer says if you put in up to 6%, we'll give you 50% matching, which is up to 3%. So you take 6% of your salary. Let's say you're making $50,000 a year. You put in $3,000, which is 6%. Your employer throws in $1,500. That's the free money into your account. That's exactly the same as your employer saying to you, here is a 3% raise if you would like to take it. It actually is like your employer saying that to you. That's why I am stunned when I see those who don't take advantage of it. Now, if there's some pressing financial needs, so be it. But except for that, there's no reason to walk away from free money. So check to see if you have a matching program in your 401k or 403b. And if you do, for heaven's sakes, if you can afford to do so, make sure you at least contribute to the amount that will max out the free money, the matching. Now, I'm just throwing 6%, 3% out as an example. Some might be 4%, 2%. Some might be more or less. But anyone listening to Money Talk that has a matching program in their tax-privileged offering from work, please think long and hard about taking that free money that your employer is throwing at you if you'll just take it. So we have the IRAs, we have the 401ks, 403bs, 457s, and look at the limits on those 401ks and the rest of them. Look at that, the 403b, 457, $18,000. And if you're 50 or older, throw in another $6,000 for the catch-up mustard program. I mean, look how much money you would have to put away on a weekly paycheck. Well, let's say you're under 50 in your program. Well, we'll pretend you're paid weekly. 52 paychecks, $346 a week. But if you're 50 or older in 52 paychecks, that's $461 a week. These are amounts that are so high that not everybody can even afford to do them. But if you can afford to do so, and if your program allows you that much of a contribution, you always have to check that out with HR, and well, believe me, they'll tell you if it is top heavy. But some of these programs are top heavy, with senior executives putting in amounts of money that may have an impact on what you can put in. But these are the limits. If your program is not top heavy, these are the limits. And on the IRAs, $5,500 or $6,500 for those 50 plus. So these are programs that are just absolutely outstanding that are available to those within the sound of my voice, and I encourage you to take advantage. I'm Bob Brinker. This is Money Talk.
Money Talk.
And we have Harv on the line in Boston. Harv, welcome to Money Talk.
Oh, thank you for taking my call. I have a question regarding asset allocation. Every week I hear about a 50-50 allocation for somebody who is near retirement or age 60, but I'm not sure. What would you feel comfortable with somebody who's 50 or somebody who's 40 and not going to be retiring until age 65?
I would say somebody in their 40s that plans to work till at least age 65. I'd probably be comfortable with 70-30.
Okay, and age 50?
Yeah, I think 2/3, 1/3 to 70-30 on the equity side. This assumes a positive equity market outlook, which we have had for a long time. Yeah, that would be the approach that I would take. Something along the lines of 2/3 to 70% on the stock market side, and the rest would be on the income side. And yeah, I think that would be age appropriate for someone in that area of the late 40s or close to age 50. And again, somebody that plans to work out till they're, let's say, at least 65 years of age. I think that would be a workable allocation. I appreciate the call. Thank you. Julian is on the line in Wisconsin. Julian, welcome. Hello, Julian.
Hello, Bob.
Welcome.
All righty. I'm 59 and a half, at critical mass thanks to you. Now, in my portfolio, I have about a 50-50 split, like you mentioned, for older people in this case. Now, my question is, I have about $500,000 at 1.2% in a guaranteed account in my 401 plan. And I was thinking about moving some of that money to a balanced fund with the intention of, being able to make more than 2.2%, but on the other hand, not taking too much more risk. And the balanced fund I was looking at was one that's listed in your newsletter. Thoughts at this time with the market being as high as it is and interest rates where they're at?
Well, let me get this straight. This is your fixed income money, right? This is not stock market money.
That is correct. This is part of my 50 in the fixed income portion.
So of course you know that if you went into a balanced fund, you'd be placing a portion of that into the stock market.
Yes, sir.
So that would change your asset allocation.
Yeah, I wouldn't take that full 500. I would take a portion, that type, to try to keep that balance between 45 and 50%.
How much of it would you take?
I was thinking about moving about 100 now.
Well, 100 would not move the needle dramatically.
Right.
Although you do have the question of how much new money you want to put into the market at this point. That's always a question, especially since you're asking this question if the market has had a terrific year, double-digit gains in the market. So you really have to ask yourself whether you want to do something like that in anything other than a dollar cost average form.
Well, and that's exactly what I was, thinking to myself. On one hand, I could probably make more than 1.2%. And if the market goes down, I'm not going to sell anything. I'm going to ride it out. And I would dollar cost average that percentage in, kind of like you're talking, over time. On the other hand, 1.2% with bond rates being what they are and interest rates going up and the market where it is, that maybe isn't the worst thing. And, I could wait a year or whatever it turns out to be. If there were a major drop in the market, I could put some money in. That's kind of where I'm on the fence right now.
Yeah, I can understand why you feel that way. I think if you're talking about $100,000, and if you're going to dollar cost average that money, it's not going to move the needle very much. But if you feel as though that might be a better way to put some of the money to work versus the 1.2. But keep in mind one thing about the 1.2 that is positive, and that is that the 1.2 is not going to cost you money as rates go up. Increasing interest rates should not hurt your 1.2, because that money should be guaranteed.
That is correct.
Julian, I thank you for the call. Great to hear from you. Let's get out to Albany, New York. Dave, it's your turn.
Hi, Bob. Thank you for taking my call. I'm currently in portfolio number one. I have hopefully 8 to 10 years left to work. What my question is, or a couple interrelated questions, I believe. What role should cash play in retirement and taxable accounts play, taxable securities accounts play in retirement?
Well, this is one of the reasons that we encourage our Money Talk listeners to take advantage of the tax-privileged accounts that are out there, so that you can, over time, you can move a material amount of money into tax-privileged accounts. Now, I specifically cite the benefits of IRAs and then also the 401k, 403b, 457 programs that are offered by so many employers. These are programs which, through regular contributions and through appreciation over time, you can build yourself a really nice percentage into those types of accounts, because it can be very difficult to create large amounts in such accounts at the snap of a finger. This is something that accumulates over a long period of time during your working years. Yeah. So I do encourage subscribers to take it, listeners, I should say, to take advantage of this. But I must say that it does take time to accumulate the money. Now, the money that you have in personal accounts, it is what it is, right? Because it's the money you were not able to put into tax-privileged accounts. And so that's going to vary from investor to investor.
Okay. Like earlier in your show, you mentioned 3 to 6 months of cash.
Yeah.
Should that be maintained through retirement as well, or should retirement be a little more or a little less?
I think it should, and 3 to 6 months covers a lot of ground. I'll tell you why I think it should, because even though in retirement you're not going to lose your job because you don't have one, there still can be unexpected emergency expenses that arise, whether they be medical, whether they be accident-related, whatever. And for that reason, I do think 3 to 6 months in contingency reserves, shall we call them, contingency reserves. And these are not part of your investment portfolio. These are emergency monies.
Right.
Okay?
Okay, thank you very much.
Thank you, Dave. Good to hear from Albany, New York. Roy, it is your turn. Welcome.
Hey, how you doing today?
Doing well, Roy.
I have a lot of questions. I'm going to try to get a couple of them through you. I'm 41. I don't have anything saved up or anything started. My wife has a 401k. I don't have any faith in Social Security whatsoever. Where and what should I do? I would like. I've looked at the numbers, and I know I'm way behind the 8 ball as far as retiring with. If I do just a mutual fund, any significant amount of money, unless I put in a significant amount of money.
Well, Al, I'll tell you what. It's funny because I just received a communique this month from a Money Talk listener. Awfully nice of this Money Talk listener to take the time to do this. And it starts out, and it really relates to your situation directly, Roy. And I think it answers your question directly. And he writes, I am a successful investor. I was not always so. He is in his late 50s, Roy. He says his wife works in the medical profession. She's not a doctor. And he works as a mid-level manager. And he says his wife worked sporadically as they raised their child, took time out to get a college degree, and has worked full-time only for the last 10 years. These are all future years for you. You're only 41. He writes, neither of us has had any stellar inheritance bonus, stock options, or trust fund. We started with nothing. And he writes that by the late 1990s, they had some meager investments, and they were earning pitiful returns, he writes, even though we were in a big bull market in the late 90s. He says he was completely frustrated with his investment management, and he did not know where to turn. And he writes, that's when, now you've already taken this step, he writes, that's when the person most responsible for his investment success stepped up, and that was his wife. And she did that by suggesting to him that he listened to Money Talk. So he did. And I'm reading from his communique. Initially, he thought, okay, just another talking head. But over time, he said that he heard a number of the gift horse buying opportunities we called on the radio, as well as, of course, in the newsletter. And he said he did not follow them. And then he went on, he listened some more. He listened to our sell signal in 2000. He listened about our buy signal in 2003. And he moved into the stock market. He's been following that recipe ever since. And so he cites the Money Talk broadcast as the second reason for his investment success. Listen closely to the third, Roy, because I think it can help you. The third is someone we've recommended and interviewed on our broadcast and who has books on our recommended reading list in the book section at bobbrinker.com, and that's John Bogle, B-O-G-L-E. And he says that he writes in his letter, if you can only read one book on the list, and there are dozens, read Common Sense on Mutual Funds by John Bogle. He says actually he's read it several times and uses it as a reference work and considers it the Bible of investing for common folk. And he offers the book to anybody that wants it for investment advice. So this is what he wrote, and he has reached the land of critical mass as a result of his efforts over the years. And he says that this is a guy who started really from scratch, and he did it started in his 40s. You're only 41. And he says that he estimates that their earnings will exceed their spending significantly. And so they're in the land of critical mass, and he says they're blessed. So I would say that's the answer to your question. I would start with, you've already started by listening to Money Talk. I would read Common Sense on Mutual Funds, and you'll be on your way. I'm Bob Brinker. This is Money Talk.
This is Money Talk.
I can take money and I can make it into more money.
25 years on the air with advice on money matters. Here's your host, Bob Brinker.
that is America's money program, Money Talk. Coast to coast, border to border, in the islands of Hawaii and north to Alaska. Money Talk is the program that helps you to learn how to become your own personal financial manager, and that's how you leave the sharks out of your life, because you take charge of your personal financial future. Everything from investing in your tax-privileged accounts to saving for all of those future goals, including the very important goal of the education of the young sprouts. That's what it's all about, acquiring the knowledge that empowers you to manage your financial future. And of course, on Money Talk, we've talked about this for over 30 years now, achieving personal financial freedom for yourself and your family, so that if you can not say that you're there right now, you can someday hope to live in that land of critical mass. Mark is on the line in Harrisburg. Mark, it's your turn.
Hi, Bob. I'd like to get your opinion about a pension offer my employer is giving me.
Sure.
Bob, I'm being offered a lump sum one-time deposit into my 401k in the amount of $300,000 versus a lifetime annuity payable at $1,600 a month, which will terminate at my demise. I'd like to get your opinion about that.
Now, that monthly amount comes out to $19,200 a year. Is that amount indexed to inflation?
No, sir, it is not.
All right. So we have the possibility of collecting $19,200 a year, and the lump sum behind that is $300,000. That's 6.4% yield is what that is, if you wondered. They're offering to pay you 6.4% of the $300,000 that you otherwise could take in a lump sum. Let me ask you a couple of questions about this. Firstly, do you have a spouse in the house?
Yes, sir, I do.
Is there a survivor benefit involved?
No, that would be no survivor benefit.
Okay. All right. Well, let's take a look at this then.
Okay.
No survivor benefit. 6.4% is the yield on the $300,000. It is a fixed amount so that any inflation that occurs comes out of your pocket because they're not indexing it to inflation. On the other hand, you have the option of taking the $300,000, not counting this money. Mark, what is your net worth?
Slightly over $600,000.
Whoa, Nelly. Whoa, Nelly. So you're talking about increasing your net worth in a situation where you have no survivor benefit. You're talking about increasing your net worth with the lump sum by 50%.
Yes, sir.
From roughly 600 to 900, right?
Correct.
And if anything were to happen to you, that money would be available to your spouse if she were to outlive you to help with her cost of living, right?
Yes, sir.
That's a big deal. I mean, I'm reacting myself. This is your decision. But to me, that's a big deal. Now, the 6.4% yield, I know that is something that looks pretty attractive right now in this low-interest world we live in. At the same time, you're foregoing $300,000 that I would think you could probably roll this tax privileged into an IRA, right?
Yes, sir. That was my plan.
I'll tell you what. I'm not deprecating the 6.4% yield in any way because that's a reasonable yield, although there are a couple of things I don't like. I don't like the fact that it is not indexed to inflation. I don't like the fact that since you have a spouse in the house, it is not providing a survivor benefit. I think those are both negative inputs. But almost overwhelmingly to me, the ability to increase your net worth by 50% from 600 to 900,000 roughly, that's a big deal the way I look at it. So in my opinion, I would take a very, very serious look at rolling that lump sum into a self-directed IRA.
Well, I value your opinion, Bob, and I thank you very much. That is basically the way I was looking at it, but I needed to hear it from your lips.
Thank you. Appreciate the call. Now, you see, there were some critical factors in that decision. I'm glad Mark agrees with my view because I think he'll be doing the right thing. There were some critical factors in that process of making a determination. One of the critical factors, there's a spouse in the house, but there's no survivor benefit. Another critical factor, not indexed to inflation. A third critical factor, a 50% increase in net worth by taking the lump sum in a tax-privileged account. All in all, that money could, I think, be used for a 4% guideline annual withdrawal, and also that money would then be Mark's money. So that's definitely where I would lean on that one. And I do appreciate the call very much, Mark. Money Talk comes your way each and every weekend talking about subjects financial. Let's get Mary on the line. Mary checks in from Sarasota, Florida. Hello, Mary.
Hello. I'm calling about the ad about the U.S. state silver bars going to residents in 49 states, and you can call up and order whatever is left. And but I wondered if you'd seen that, and if they're pure silver, 0.999 in each bar. And
yeah, I can't see any reason to do that because anybody that wants to speculate, and that's what it is, speculate, if I may finish, anybody that wants to speculate in silver can do so very, very easily in the iShares Silver Trust. I have no recommendation to buy the iShares Silver Trust, and actually I never have. The iShares Silver Trust is basically traded during the market trading day.
I see.
And basically it follows the price of silver. So if you want, for some reason, to speculate on what people will be willing to pay for silver in the future, it's easy to do that speculation in the iShares Silver Trust, symbol SLV. I don't recommend it because I regard it as an outright speculation, and I do thank you for the call, Mary. Appreciate it very much. This is Money Talk.
Money Talk.
For information on my investment letter, that's Bob Brinker's Market Timer investment letter, go to bobbrinker.com and request a complimentary bank issue. That's all there is to it. Go over to the website homepage at bobbrinker.com. Click on the Request a Complimentary Bank Issue feature. And while you're at the website homepage, check out the information on Money Talk On Demand. You can stream Money Talk on your computer, download our broadcast to your smartphone. And that is Money Talk On Demand. And that way you listen wherever you go, whenever you like. And, of course, the investment talk is year-round. Sign up at bobbrinker.com, right there at the Money Talk On Demand logo. And you're welcome to do that as well. Let's get Chris on the line in Washington. Chris, it is your turn.
Hi, Bob.
Hi.
Gosh, I just have a quick question. I've been listening to you for a long time, and et cetera. And I think I know what you'll say to this question, but I need to rebalance my portfolio. I'm kind of looking towards retirement in three to 4 years. I got one more daughter to get through college, but I think I've got pretty much that paid for. The question is, I need to reallocate, perhaps right now, because it's bubbled up again. I want to get down to about 60% equities, 60-40 ratio, and it's bubbled up quite a bit, like 15%. And my question is, should I do that now, or maybe should I wait? And when these funds, whether they go ex-dividends, does that matter?
Are these taxable or tax privileged?
No, it's all tax privileged.
All tax privileged?
They're all in IRAs, all 401k.
Well, then it doesn't matter what kind of a dividend they pay to you because there's no tax at this time in a tax privileged account.
No taxes at all, just that. But I was under the impression that it's a bad policy to sell a fund before if they're going to do distributions and the dividends. What do you think about that?
Well, for one thing, it certainly would depend on whether it's a taxable account or not. In a tax privileged account, it would have no meaning. In a taxable account, It would only have meaning if you saw that the distribution was going to be a negative for you on your tax return. For example, I'll give you an example of what I'm talking about. Let's say you had a large fund position. If it's a tiny number, it wouldn't really matter much. Let's say you had a large fund position and you had a long-term capital gain in the fund in terms of your holding period. And you called the fund and you found out that they were going to make a large distribution, and that a significant portion of that distribution would be short-term capital gains. Well, then clearly it would be to your benefit to take, if you're going to sell anyway, of course, this presumes you're going to sell anyway. It's a question of what day you sell. Then it would be to your advantage to take the long-term capital gain rather than await the distribution, which would include a short-term capital gain, if that's the way it would turn out. That would be an example of a person that's going to sell anyway, and they're just trying to pick what day they're going to sell. And so in order to avoid the short-term tax treatment on that part of the distribution, they would simply sell and take the entire amount prior to the distribution as a long-term capital gain. That would be an example of why somebody would do that.
Yeah, so I guess you have to go to the fund to find that out, the fund manager to find.
Yeah, you would have to do some homework on that. This is a long-term position for you?
Oh yeah. I've been listening to you since the '80s.
Okay, wow.
Yeah,
So you have made a ton of money in that fund, I can assure you.
Yeah, no, thank you very much. I can't believe after all these years I've even looking at critical mass. I would be there right now, but like I say, I got one more daughter coming to college. I'm kind of waiting to see what those expenses are going to be like. Which brings up a point. We did, when they were babies, and I was listening to you, we started the funds, Universal Gift to Minors Trust Act fund for her in the total stock market, and it's gotten huge. It's just
How big is it now? How big is it?
$50 a month, right? And it's huge. Yeah. So anyway, that's the question. That's not tax privilege. That's going to be in her account, and it would be good to rebalance that, get out of that right now, because we need to use that money.
Well, if you have to use the money, then certainly it should be in a money market fund so that you can spend it. How much is in the account now?
About I hope she's not listening.
I see. Well, you think she might be listening? Well, then in that case,
it's about it's about $50K right now.
That's amazing. Well, congratulations on a job well done.
Yeah, and I guess the answer to that obviously is I got to get out of that and get it in money market right now.
Well, you certainly want it to be where you need it when you spend it.
Yeah. All right.
Okay.
Well, thanks a lot. Like I said, sometimes I've been listening for a long time. Sometimes I just tune in just to hear your voice, and I know it's all right in the world, and then I go on to my other stuff. So thanks for your great work.
Thank you, Chris. Chris checking in from Bainbridge Island in the great state of Washington. Patrick is on the line in Springfield. Hello, Patrick.
Hey, Bob. How are you?
Doing well. What's up?
Hey, I have the opportunity to buy some investment property. It's basically a vacation rental. After I pay principal, interest, and taxes, I'll net about $600 a month. What I'll need in order to do this is $30K. I don't have any cash laying around. All my money is in a 401K, and I was going to borrow the $30,000 from the 401K. What are your thoughts on doing that?
Okay, so if you took the loan out from the 401K, would you still be allowed to contribute?
Yes.
Are you sure of that?
Well, that's something I guess I need to double check.
Yes, you need to be sure of that. You need to be sure that if you take a loan from your 401K, that the company plan will still allow you to make your regular contributions to the plan. That's an important part of long-term investing.
Well, and maybe I need to just clarify here. I have two 401Ks. One is from a previous job that I had that I rolled over, and it's in a separate account with a separate company, versus my current company where I could continue to putting money into the 401K. I would be borrowing it from that other account.
The old 401K.
The old 401K, which you're right, I probably can't contribute any more to that one, but I have about $150K in that one.
So you're thinking of borrowing $30,000 from that 401K?
Yes.
And then following the rules on paying it back?
Correct. And just wondering what you think about doing something like that. Sometimes I've read that you get double taxed if you do something like that, and it's not necessarily the best investment.
Well, I think that the investment that you make is going to be critical in this decision. If you have some great rental real estate proposition that you're looking at that you feel highly confident about, then that should, if you're correct, that should take care of the investment side.
Okay.
So the question is, if you're taking a loan out of an old 401k that you're no longer contributing to, the question is, what obligations do you have in terms of being able to repay that loan and everything that goes with it?
And by that you mean, my understanding is you repay the loan and you pay percent interest for taking that loan out, but that percent interest goes to you.
Yes, it goes to you, but the question is, do you have the money to make those payments?
Oh, right. And I believe I do.
Okay, well, if you have the money to make those payments, then you should be okay as long as the people who are administering that 401k tell you that you have the ability to borrow that $30,000, and they tell you what you have to do in terms of the repayment program. And then if you say, I can meet those terms, then if you have a great real estate rental proposition, then I think you're okay.
Cool. All right. I was just wondering because the bigger question I think I had was, you're repaying that loan with after-tax money, and the money that was in there that you're loaning out, was pre-tax, right? So you take a bit of a hit doing that.
Well, wait a minute, time out. I thought this was a loan.
Well, it is, but I'm paying it. I'm assuming I'm paying it. After I get my paycheck, I write a check and pay back that loan. So it would.
Well, you have another option here. You could go to a bank and borrow $30,000.
Right. I guess what would be the disadvantage of? I always thought it'd be better off going to your 401k than going to a bank and.
No, but what I'm saying is that would be the comparison. The comparison would be, okay, I can borrow the $30,000 out of an old 401k that I'm no longer contributing to. Okay, that's one option, and I'll pay them back on the terms, and the interest goes in my account. All right, that's one. The other alternative is to borrow the money from a bank.
Gotcha.
Okay?
Yep, very good, sir. Thank you very much.
Thank you for the call. Good to hear from you. We come your way each and every weekend talking about the tools that helps you to learn how to become your own personal financial manager. This is Money Talk. If your life's a never-ending IOU, or if you're the president of the Bank of Mom and Dad, you're always welcome right here on America's Money Program, Money Talk. Here on the broadcast, we talk about a number of things that you can do to make a big-time difference during your lifetime with your money. And we've talked about these topics for many, many years on our broadcast. And a lot of our callers over time bring them up and say, yeah, it works. And I think they're right. I think these thoughts do work when they're put into practice. One of the ideas we've talked about is paying yourself first. Now, what does paying yourself first mean? It means that when you get your paycheck, that you take something off the top, a minimum of 10% if you can afford it, but more if you can afford it. You take that money off the top and you place it in an investment account. Now, it's easily done if your employer offers a 401k or a 403b or a 457 program. It's easily done, and in some cases, you can even pick up a bonus amount in a 401k, for example. Frequently, the employer will put in what's called a matching program, and that will allow you to bring even additional money into your account as a result of your employer participating in your contribution. A typical example is you put in 6% of your pay, your employer matches half of that and puts in another 3%, which means 9% of your pay is going in that case. And these percentages, of course, can vary. But the idea of paying yourself first is that you have a regular program over time of putting money aside for your investment objectives. And those investment objectives can be retirement objectives, education for a family member objectives. They can be varied, but the important thing is that something's done about it, that something is put aside for the future. And that's what pay yourself first is all about. I recommend it. Another of the cornerstones that we talk about is maximizing your tax-privileged programs, such as the one I just mentioned with the 401k, but whether it be a 403b or a 457, maximizing your programs up to the allowable limit, if you can afford to do so, to get that money squirreled away. Because the tax privileges that are attached to that are huge. For example, if you go with the traditional accounts, you get to deduct the amount you contribute from your income for that year. It's not taxed in that year. It's not taxed until you take it out way down the road, where hopefully it's a much larger amount. Another item we talk about is by controlling your expenses. The idea that you're going to look at your portfolio and try to keep your expenses down. This is why we include index funds in our equity model portfolios in the investment letter, for that reason, because they help not only to provide great diversification and tax efficiency, but they also keep costs down. And that's an important plus as well. And for those of you that have credit card balances, if you can do so, we strongly recommend paying them off in full every month, because as a general rule, the percentage interest that is charged on credit cards is usury. Now, to me, usury in the current environment is 12, 15, 20%. And if you look at credit cards, sometimes they're department store cards. But if you look at credit cards or department store cards, you'll often find that they will charge interest rates of 12, 15, 20%, or even more on unpaid balances. Therefore, by paying them off each month, you can avoid those charges. And it certainly is well worth avoiding charges of that magnitude, especially in this low interest rate world we live in. Another thing you can do is pay attention in general to the costs of your investments. We had a caller on the program today. It was astounding. He has been talking to somebody who has recommended to him that he take his $75,000 tax privileged money in his 401k, take the money out, pay taxes, federal and state, and then buy life insurance products, which tend to be very costly in many cases. This is a train wreck, as far as I'm concerned, and I'm glad he called. But think about the fees and expenses and taxes that would have been involved, that were involved in that recommendation. We hear people out there say things that are so patently absurd that I sometimes have to ask myself if I'm sleeping and dreaming a nightmare. You know, comments that make no sense, comments like negative comments about 401ks, negative comments about IRAs. This is absurd. I said it prior in the program today. It does bear repeating. The 401k programs and the IRA programs, those are two of the most outstanding programs that have ever been afforded to American workers. And after that, I can say full stop. Done and done. They are. And to go out there telling anybody that they're anything but that is, well, unfortunate. Unfortunate. We'll let it go at that. Since it's a family broadcast, we'll let it go at that. It's a crying shame is what it is. All right, let's get out to George in San Diego, California. Hello, George.
Thanks for taking my call, Bob. I have most of my money in a Vanguard Total Stock Market portfolio. But I have two managed funds, Windsor 2 and Prime Cap. And I wanted to see if, the long-term, like, I guess 5 years or 10 years, the performance of these two funds are worth it because, as you know, the expense ratio for them was much higher than, for instance, the total stock market portfolio, which I pay Admiral shares 0.05, as opposed to 0.34% for these funds, Prime Cap and Windsor 2.
So what you do is you take a look and make sure you're dealing with all equity funds when you make this comparison. That's very important. You want to compare all equity funds with all equity funds. But all you have to do is go to Vanguard.com and check the historical figures for various periods, and that will answer your question. Money Talk comes your way each and every weekend, talking about subjects financial. Let's get Mike on the line in Virginia. Hello, Mike.
Hey, good afternoon, Bob. A couple of questions for you. I'm retiring from the military, and I'm going to be looking at about $4,000 a month in my retirement pension, plus about $1,000 a month in a tax-free disability. Now I could take less in that retirement payment and sign up for the survivor benefit plan. It'd be about $800 a month, and just trying to figure out if that's a good plan, or if that's something that I can cover with life insurance down the road. With that, as I retire, I'm looking to transition as an airline pilot, so I'll have a mandatory retirement at 65.
Well, $800 a month is a lot of money. You could buy a lot of term life insurance for less than that.
That's what I was thinking.
I think you're right.
Okay.
I think that I'd be inclined to take the full amount and buy term life.
Okay, excellent. I appreciate your reaffirming me on that. Second question is, so I've got about $78,000 in the government TSP, and about $10,000 of that is in the Roth TSP. Is that something that I should just leave in the TSP program, or should I roll that into?
Now, for our listeners that are not in the program, tell them what you mean when you say TSP.
Okay, it's the thrift savings plan, and it's basically a 401k type program for government employees. Normally it's for the general service employees, but the last few years it's been opened up to military members as well.
How's that been doing?
It's been doing okay.
So what is your question relative to that then?
Is that something that I should leave in the TSP, or should I just roll it out into private funds?
Would there be any tax cost to that?
No.
Is this eligible to roll into an IRA?
Yes.
Yeah, you might consider. I mean, if you feel like you're in a position to manage this money in a self-directed IRA, I would consider that possibility.
Okay. Okay, very good.
Thank you, Mike. Let's get Julie on the line in Oregon. Hello, Julie.
Hi, Bob. Thank you for taking my call.
Good to have you with us. What's up?
Well, we sold our big house. We're only living in one place now, and it's a much smaller house. And I have $400,000 from the house. I have a little over 50% in, probably equal amount in right now in a brokerage, not a brokerage, a managed account. I think that was a mistake. Transferred it where my husband had his. And anyway, I don't know what to do with this $400,000. I don't qualify for an IRA, right? I can't do a 401k. We're 84 years old. So I'm just not sure what to do. I transferred out of one bank account, go to a credit union. It's a smidgen more interest, but it's just sitting there.
Well, there's no reason to be concerned. It's all good. It's all good. $400,000 is a good thing. And what I would do, I assume you have no tax liabilities outstanding as a result of this transaction?
No.
Okay,
and
so
we don't have anything. We don't owe anything.
Good. $400,000. Do you have a mortgage?
No, nothing.
Good.
We don't owe anything.
There you go. So $400,000, put that in the asset column, and I would say that at the minimum, you could put together a ladder of FDIC insured certificates of deposit, which would generate a small amount of interest for you and keep the money safe because of the full FDIC protection. There's no reason to lose any sleep over this if you invest this money in a way that is safe. I don't see any reason for you at your age to be going out taking a lot of risk. I really don't. I think it might be as simple as just keeping the money safe.
Okay, so don't worry about investing it or doing anything with any more equities. But I got lots of Vanguard in my.
Well, let me ask you a question. What is your, including this $400,000? What is your net worth?
With the other.
Well, net worth. Let me define. I'm sorry. I apologize. Net worth is all of your assets minus your liabilities.
All of our assets, including the house, including what I have at the.
I'm not talking about your Chase Lounge. I'm not talking about your car. No. I'm talking about equity in your home, all your investment accounts, all of your financial assets minus your liabilities, but you don't have any liabilities.
We don't have it. Probably $1.25 million. All
right. So that includes the 400, right?
Yes.
Now, out of that $1.25 million, how much of that right now is in the stock market?
It's a little over 50% of 464,000.
So 464,000 is in the market, or half of that?
A little over half.
Okay, so about maybe 250,000 in the stock market.
I guess I'm a newbie. I have American Mutual, Apple, Daimler, PowerShares, Sternberg, Vanguard.
I'm not going to ask you to list all your holdings. I wouldn't do that. Yes. But you have roughly 250,000. And what's your tolerance for risk? Do you have a high tolerance for risk or a low tolerance for risk?
I'm kind of in the middle. Not too much risk.
I don't see any reason for you to be taking a lot of risk and causing yourself a lot of potential upset. If something goes against you, I'd be inclined to put together with these funds, these additional funds, a CD ladder for the time being. In your situation, you're still going to have your money in the stock market. Julie, I appreciate the call. Thank you for joining us. More to come. It's Money Talk.
Money Talk.
For taking my call.
What's up?
I just start off with, I'd like to offer some encouragement to what you just said about using all the tools you have to try to build up for retirement. I started out in dire circumstances at 21 years old and saved a little at a time, did all the things, most all the things that you mentioned. Some I learned late, but anyway, I was able to, let's put it this way, not be po no mo. So anyway, I appreciate your advice, and like I said, I'd like to offer encouragement to everyone else to do that as well and do the best they can. You can't always be perfect.
Well, I think your comments are well taken, Brian. I mean, one of the ideas behind this is that our listeners do not become roadkill for the sharks.
Correct. I totally agree. Yes, sir. And there's a lot of junk out there. Knowing a little bit of knowledge can be dangerous, and the gentleman that called in, his agent probably told him that 401ks were not good investments. There have been some issues with regard to expenses in 401ks, and that the agent might have been trying to convince him that a little bit of bad news killed the whole thing. And that's probably where we can go wrong.
Well, actually, there's a way around that. If you're not happy with the expenses in a 401k, then just go to the index option. Just buy the index funds.
Exactly. So that was well said information just a moment ago as well. But my question regards my holdings in my self-directed IRA. I have a rather substantial amount, for me at least, in the IRA, and I'm as concerned as many other Americans about a downturn in the market. Is there a way that I could use some derivative style of instrument to, and I know that's speculative, but to use some type of derivative style instrument that without buying a mutual fund, shares, or other things like shorting the market, is there some way that I could do that within an IRA to sort of be used as an insurance policy for my IRA if the market took a downturn? And I am an index fund, so I'm well balanced, just general right now index funds. And I'll wait for your answer.
Well, I think that one of the questions would be, what about doing something like writing call options?
Can you do that within an IRA?
Well, that's something you want to check on.
Yes, sir. That's my question.
That would be something to check on. Yes, I would say that that would be something you could look at. Keep in mind when you write call options, yes, you get the premium.
Yes.
But there are a couple of other aspects to it. You still own the stock, so if the stock goes down, you still own it.
Yes, sir.
Your decline is blunted somewhat by the premium you've collected, but it still goes down, and it's your stock. So that's one thing. That's one thing to consider, and certainly also, obviously, if you're writing covered call options, if the stock soars, you're not going to fully benefit.
Mm-hmm. Well, again, these are index funds, so I don't, I understand what that the mutual fund owns the shares, the index fund, but I guess my question is, how do I find out whether that's legal or not? What entity should I call a certified financial?
I would go to your human resources department and ask them what the rules are in the plan. You go to the human resources department that used to be known as the personnel department. Ask them.
Not a plan.
Pardon me?
I'm not in a 401k plan. I'm in a self-directed IRA.
Self-directed IRA. In a situation like that, I would go to your brokerage house and ask them what rules apply to the account.
Okay. All right.
Brian, I appreciate the call. Thank you very much for joining us, and you made a lot of very good points. Now, this is not, this is not the answer to everybody's problems, right? But in his case, he's worried about the market. And so he's wondering if he could write covered calls. For example, if he owns spiders in his account, he mentioned he was indexed. If he owns the spider exchange-traded fund, I'm sure he'd find no problem at all writing covered calls on spiders, and he'd collect a premium, and he'd still own the spiders, but he'd be getting some income along the way. And if they were to rise tremendously for some reason, then they would be called away. Now, the nice thing about writing covered calls in an IRA account, for those that have reason to do so, such as reducing their overall level of risk as well as their overall upside, is that you are getting that premium income coming in, and it's in a tax-privileged account, so you're not getting hit with taxes right now. Before they beam me out of here, let me thank all of our Money Talk Trekkies for cruising with us on the Starship, our program coordinator, Ravi Chandran, producer, Meredith Oakes, and our technical directors, Angel Bordone and Mr. Bob Mack. Till next time, happy investing, and may the odds be ever in your favor.